Well, good job. You come a long way in this training where you've reached endpoint of this phase or this part of training. There's one last thing that you need to learn, and that is lots. How to determine what lot you're going to use. It is the difference in how much you're going to make. You can make a little or you can make a lot. And that is determined by the number of lots that you're able to use. If you look at our trade that has been running since the beginning of this training, price is starting to come back down. You learn how to calculate the pips from where we started up here at 1.07365. You learn how to calculate the pips from that point down to current price action. Now remember, this is Euro USD where we are in a sale. If we are in a long, we would actually be negative that amount of pips. But because we're in a sale going short, we are positive that amount of pips. And because of that, we have a profit of just over $4,200 right now. And we've been as high as 6,000. We started from zero. So this is all profit. So you learn how to calculate pips, but how do we actually get to translate pips into profit? And you're going to learn that in this video. So I did a recording. Let's jump to the recording so we can learn this last piece before we move on to technical analysis.
What the market players do is they speculate how many pips price is going to move. And they do this by way of lots. I'm going to break this down to you. And it's a very simple concept. So we know how to count pips. Keep that in the back of your mind. And let's talk about lots. So they're speculating how many pips price will move. And then they speculate what the direction that the price is going to move in. And they place a wager, which is called a lot, on every pip movement in the direction that they have speculated. And that is how you make money. Lots are the wager that you are risking per pip movement. So to bring this point home, let's do another exercise. So let's look at this. Let's say that on one end you have four people that's waging, four market players that are waging a price per pip. Every time a pip moves, person one, they're going to risk a penny for every pip. Person two is going to risk 10 cents per pip. Person three is going to risk $1 per pip, and person four is going to risk $10 per pip. So let's use our examples for this. Let's use Euro USD, which y'all all calculated that to be 141 pips that the price moved, and it was a long. Person one who risked a penny per pip on that 141 pip move would have made $1.41. Person two that had 10 cents per pip would have made $14.10. The one that risked $1 per pip would have had $141. The person that risked $10 per pip would have had $14.10. All right, so that's an easy concept to understand. And that's how trillions of dollars are moved throughout the world with that simple concept. AUD CAD, we said it fell 66 pips. Person one that risked $1, that's 66 cents. Person two that risked 10 cents got $6.60. Person three would have got $66. And person four that risked $10, $660. This is the concept of how money changes hands, of speculating on where price is going to move and how far it's going to move, and then uh, um, uh, waging a lot per pip movement. Simple concept. And that's all it is. That's all it is. And that's all it is. Let's keep pushing through that this concept because we're just building tonight. Euro JPY, we said that failed 513 pips. So again, depending on what lot size they use, $1 per pip, 10 cents per pip, $1 per pip would be equivalent to how much they would profit on that movement. All right. So I have these specifically here for a reason. This penny per pip, this 10 cents per pip, this dollar per pip, this $10 per pip, because these are standard lot sizes. You have a nano lot, a micro lot, a mini lot, and a standard lot. It's like buying a carton of eggs. You can buy them in groups. So in lieu of buying one egg at a time, you can buy 12 at a time, or you can buy 24 at a time, or you can buy 48 at a time. We can in lieu of but we can buy this in clusters. And so we have a nano lot, which is the lowest lot that you can go. It's a penny per pip. And it's represented as this 0.001 lot. Let me start from this end. $10 per pip is a standard lot. That's one lot. So $1 per pip would be a mini lot, which would be 0.1 lot, 0.1 of a standard lot. 10 cents would be 0.01 lot, 0.01 lot of a standard lot. That's a micro lot. A nano lot would be 0.001 lot, full lot. That's a penny. All right. And so we're going to see this as we get towards the end of this day. This is how we're going to be able to place how much we're going to wage in our market order by the lot. So let's say I wanted to ask what. Let's say I wanted to wage. I wanted to wage $50 on Euro USD going long on a $50 per pip. How many lots is that? How many standard lots is that? Mika says 5.
5, yes.
Joey says 5. Everyone's in agreement with that. That would be 5 lots. So you see how in the global economy, if I want to raise 50 US dollars, someone in South Africa, how will they know what 50 US dollars? They're not going to pull out a calculator, see what the conversion rate is in their currency. They can simply 5 lots in US is 5 lots in South Africa. They're both worth 50 US dollars. So 5 lots. If I said I wanted to wage 8, or let's say 87 cents, how many lots is that? 87 cents per pip. And that's a little difficult. I'm gonna help you out with that. That would be 8 micro lots and 7 nano lots. 87 cents. 8 micros, 7 nanos. So it would be stated on a lot, 87 cents would be stated as 0.087 lots. All right, so now you know what pips are. I'm excited about that. You know what lots are. You know who the market players is. You know how the market, what currency strength, how the market goes up and down. Now, let's talk about leverage. So here's the thing with leverage, that if you go to the bank to buy a house, they're going to lend you, 70%, 95% of the loan, depending on the program, on the loan, and then you have a down payment. You may put down 20%, you may put down 10%, but that is you're leveraging your 5% you're going to leverage that to get a greater amount. Currency acts in the same currency leverage. I say value. It's actually currency leverage from the broker, acts in the same way that it does with houses. And so there's certain brokers that offers you leverage. And you don't have to have a credit. They don't check your credit. They don't check how much cash you have in the bank. Anyone can open up these accounts, and the bank will give you leverage to allow you to buy more. So for every dollar that you put in, they're going to give you some buying power in the market. And so if you're using a US based firm, you're probably going to see that 1 to 10, 1 to 30, 1 to 50 leverage. If you use a non-US firm or a non-regulated firm, you're going to get even greater leverage. You may get to 1 to 200, as much as 1 to 2,000, and I've seen some at 1 to 5,000 type leverage for every dollar that you put in. And so that gives you buying power in the market. And so with houses, you have equity, and your equity is essentially it's how much your house is worth, subtract the amount that you borrowed. That's your equity. And so the brokers are the same way, is that your equity is going to be how much you put in and where price has taken your profit. So if your profit goes below what you put in, then you will get a margin call. And so this is called margin type trading. It gives you the ability to enter into a position larger than your account balance via leverage, an instrument called leverage. And so if price is going higher than the amount the broker allows you to leverage, the broker will sometimes call you, which is called a margin call, and you either have to put more money up or close the trade. Majority of the time, they automatically take you out of the trade if you're over leveraged or the position is going negative against what you put in. They'll do a margin call where they'll close you out of the trade. And so the broker will notify you that your level has fallen below their required minimum level, and the trade will be closed because you're trading on margin. All right. So I have a snapshot here of MT5, and that's how we're going to finish out tonight. Is you're actually going to set up a brokerage account. It's going to be a demo account, and everything that we learned tonight, how to count pips, how to read all this stuff, you're in how to place market orders. You're going to be doing this in your brokerage account. Part of what you're going to be doing is going to be called margin type trading. And so when we do this, and we're going to do this tonight, when we do this, you'll see that you're going to be given a balance. And then when you place trades, you'll see how much equity you have. That's how much profit you're going to have in that trade. And then you'll see what your margin level is. And the important piece is your margin level as a percentage. Because if this drops below, majority of the times it drops below 100% of how much you have in the trade, or your the amount that you have in the trade, then they'll close you out of the trade. Very rarely does that get to below 100%, but sometimes it does.
All right, so we learned about lot size in this video, and now you know exactly how profit is made. So we are back on our MT5. We're in a sell position. We went down a certain number of pips, and we have profit. Now we know exactly how that profit is calculated, because on our MT5, what you'll notice is that we're in a short position, and we have 10 lots per pip. What does that mean? That means that up here we entered a lot size here, and that lot size determines how many how much profit we're going to get per pip of price movement. And so we have 10 lots, which means that every time we move 1 pip, we get $100. If it moves against us, every pip, we would lose $100. And so right now we're at 39, just under $4,000, which means that we've moved 40 pips and we've gotten $100 per pip. So that's the reason why we're profiting $4,000. And so if we wanted to risk, let's say $10, we would have entered a lot size here of 1.00. If we wanted to risk $1, we would have entered a lot size of 0.10. If we wanted to do 10 cents per pip, we would have entered 1.01 as a lot size, and that's 10 cents per pip. So right now we're in this trade with 10 lots, which is $100 per pip. It's going in our favor, and so we're right around 4,000, just over $4,000. We move just over 40 pips at $100 per pip, and we have $4,000. And that is how you make money in the market. So this next video, what we're going to do is, and we'll keep jumping back to MT5 because there's more that we got to learn, but we're going to learn charting. We're going to learn technical analysis. That how do we know that price is going to go up, and how do we know when it's going to go down? We're going to learn that in the next video.